Okay, hey, welcome everyone to another Options Millionaire Podcast. In this podcast episode, this is episode 92, doing them a little different. So, for those of you that are listening, I'm also recording these and I will eventually drop them into my YouTube channel. I am going away. So, today, the day I'm recording this is the 27th of July. And this will post on the 4th of August. So I come back the 4th. So I probably won't get posted to my to the Options Wealth Academy YouTube channel until after that, maybe the 11th or the 18th. So, but in any case, if you'd rather see more of a podcast through Apple or through I'm sorry, through YouTube, that's how we're going to do it. But okay, so in this episode, we are going to talk about overtrading and what we kind of consider the silent account killer. Um, you guys have heard me talk about this stuff in the past. I've often said that the market doesn't reward activity, it rewards discipline. Our whole tagline with the Options Wealth Academy is discipline drives results. But unfortunately, many traders equate being active with being productive, right? And so they feel that if they're not sitting in front of their computer, they need to be doing something. And when it comes to trading, it's actually the exact opposite. The easiest trade is often the one you never actually take. Today, let's kind of go through what overtrading is, and I'll give you some things at the end to hopefully help you to prevent you from overtrading. So let's look at what it is first. Most people think overtrading simply means making a lot of trades, and that's actually not the definition. Overtrading is taking trades that your strategy never required in the first place, right? So if you think about it, two traders could make five trades this month. One followed every single rule, and the other forced every entry. The first trader is disciplined, the second trader is overtrading. So the number of trades in this example isn't the problem. The lack of selectivity is. And so why do we do that? Why our brains want to trade? So as human beings, we're wired for action, right? So when markets move, your brain starts asking questions. It says, things like, what if I miss this? What if it keeps going? I should probably do something, right? Psychologists refer this to action bias. It's our tendency to believe taking action is better than doing nothing, even when doing nothing has a higher expected value. Professional investors spend enormous amounts of time waiting. That's the reality of it. And retail traders spend an enormous amount of time clicking, right? And those are two very different businesses. But make no mistake, research is very clear about this, right? So in my research, looking at overtrading, one of the most famous studies that I came across that was ever conducted on investor behavior came from professors Brad Barber and Terence O'Dean. And they actually examined over 66,000 brokerage accounts over a 5 year period. And their conclusion was remarkable. The households that traded the most earned about 11.4% annually. While that's not bad, the broader market returned 17.9% over the same period. And so their conclusion was simple: trading is hazardous to your wealth. And we've talked about that. If you think about it, the more frequently investors trade, the worse they performed. Not because market changed, not because strategy stopped working, but because the investors kept getting in their own way. And so why do more trades usually mean worse results? Well, if you think about it, every trade comes with what we call friction, right? So you have your bid ask spreads, right? And so if you're not aware what those are, so we buy at the bid, we sell at the ask, right? Or we buy at the ask, sell at the bid, sorry. And those spreads are depending on what you're trading, can be very wide. We have commissions, right? Most brokers are going to charge us a commission. Slippage. So what's slippage? Slippage is the price you expected to get when you place the trade minus the price you actually got. So this is something we don't really deal with in OWA because we use SPY and SPX, and SPY and SPX have a very tight bid-ask spread. So that bid-ask spread is important. The tighter it is, the easier it is to get something or to sell something and get the price you wanted. But if you trade stocks, sometimes those bid-ask spreads are very wide. So, for example, you could have a bid-ask spread of like $1.25 to $2.50. And so even if you targeted the mid price, right? So in between that bid-ask spread, you may not get it depending on how you place your trades and how your broker works. So this is what's considered slippage. And if you think about it, the more you trade and the more a little phenomenon like slippage comes into play, the more it's going to affect your performance or add up over time, right? Then you got taxes, right? So when we trade short term, we're in the United States anyway, we're taxed at short-term capital gains, with which in essence is your income tax. And income tax is the highest form of tax in the United States. The other thing, the last two is mental fatigue and emotional decision making. And one of the things you'll start to notice that is that your decision making becomes more and more erratic the more and more you trade. And this is why, one of the things I do now, especially in the Options Wealth Academy, is I focus more on the process and less on profits. Because it stands to reason that if you focus heavily on profits or an average return, when the market isn't cooperating, like now, you tend to force trades or even try to catch up. So most traders will focus on whether they made money. I now ask myself something different, which is what most professionals ask. I ask myself, did this trade meet my criteria? That single question changes everything, right? Now let's talk about a hidden cost that most people don't talk about. And it's something that many traders never measure. So it's decision fatigue. Every decision uses mental energy, right? Should I enter? Should I exit? Should I adjust it? Should I roll it? Should I hedge it? And basically what happens after enough decisions, your brain will begin to take shortcuts. And that's when you start to chase trades. You'll even revenge trade or you abandon your plan in its entirety. And by the end of the day or week or month, you're no longer executing your strategy. You're actually just reacting emotionally, right? So to kind of put this in perspective, let's take a case study of two traders, a hypothetical comparison of two investors, right? So trader A takes 10 carefully selected trades per year. His average return or her average return is 15%. They risk 2% per trade and they follow every rule, right? It's a hypothetical. So remember, we're not going to be this perfect, but let's look at trader B. Starts exactly the same time, but instead of waiting, he begins taking extra trades. By the year end, 70 trades, more commissions, more losses, more emotional decisions, more mistakes. And ironically, Trader B worked 7 times harder and often finished with worse results. That's basically overtrading. Now, even though that's a hypothetical, I can tell you when I used to trade more often, which was my what we call cash flow. So I traded vertical credit spreads. I used to trade those on a much shorter time scale. And my entry exit criteria was a little bit different than what I use now. Actually, it was kind of a lot different because I used a shorter term um, signal or moving average. And so, what you would often notice, even though I was profitable overall, I had a lot of trades that were not profitable. Now, I managed those losses, which was great, and I would allow my winning trades to just follow the path that I had set up. And so, at the end of the year, I would make a very good return. Ironically, today I trade not even half as much, less than half as much, like a quarter of the trades I used to trade. And my performance is very similar, if not better, right? And so the one real key difference is I don't deal with a lot of emotional issues. There's not a lot of that mental fatigue or emotional fatigue. And this is where the OWA is different. One of the biggest differences between the Options Wealth Academy and much of the financial education industries is that we don't teach you to trade more. We teach you to trade better. As a matter of fact, of all our students, the ones that have had the most success are those that are focused on the process of becoming a better trader. They're not focused on the profits. They're not focused on the return. And it often gets overlooked in our course. In the beginning, there's a lecture series called Start Here. And this is where I make it clear that my goal isn't to teach you how to make money in the market. My goal is to teach you how to become a better trader. Um, and it may seem counterintuitive, but it really isn't because making money is just one aspect of trading and investing. And in my opinion, it's not actually the most important one. Learning how to avoid losses, especially catastrophic ones, is the most important. The better you are at that skill set, the better your account will grow. And so, if you focus on the process, focus on becoming a better investor, a better trader, the profits will take care of themselves. So in OWA 1.0, we intentionally teach only two strategies. And some people will ask me why, and the answer is it's actually simple. And it's something that took me a few years to discover. And that's mastery beats variety. So the key is if you truly understand two strategies, well, then you don't need 20. And that's what I found. Once I realized, hey, this process works. So why would I need another process that does the same thing? Right. One of the biggest mistakes beginners make is believing another strategy will solve their problems. And it rarely does. It's just a bright, shiny object that gets in the way when your current strategy isn't being executed or even understood correctly. And that's really what it comes down to. So, for example, some in OWA might think our system doesn't work because over the past month, the market hasn't been going anywhere. We've gone in and out of our stage one and stage two criteria throughout the month, and it affects how we position ourselves in trades. So when we look at our two strategies, like our 3x growth strategy trades, they're just sitting there at either small gains or small losses, and they're just kind of bouncing back and forth because the market's not going anywhere. And it feels like they're never going to hit their profit target. But the system is working perfectly because it's keeping you from over trading and setting your profit targets farther out in time. Same with our cash flow strategy. The issue isn't that you need another strategy. Usually, the real issue is the execution with the strategy you currently are employing. So, our stage based system naturally prevents overtrading. This is one of the reasons our market stage system exists. When markets are healthy, we participate. When markets become uncertain, we become more selective. And when risk rises substantially, we simply stop initiating new trades. That sounds almost too simple, but that's exactly the point. You don't have to trade every market. You only need to trade your market. Many investors lose money simply because they feel obligated to stay consistently invested. We don't. The 90% cash advantage. This is another um, point of our process. It's another concept that we teach that naturally reduces over trading because we're protecting our capital. It's our capital allocation. We never advocate putting our entire portfolio to work. As a matter of fact, we never advocating even putting half of our portfolio to work. Most of our capital is often sitting in cash, safely in cash. And some people look at cash and think it's unproductive. But in OWA, we view it very differently. We view cash as flexible. Cash is an opportunity. Cash is emotional stability and it allows patience. When your account isn't fully committed, you don't feel pressured to manufacture trades simply because your money has to be working, right? And as Travis used to always tell us, cash is a position. And that's something you should never forget. So your best trade might be no trade, right? Some of our most successful students have something in common. They trade less today than when they joined. That's progress, not regression. The amateur believes activity creates profits. The professional understands selectivity creates profits. Practical ways. So let's just kind of go through some of the habits that can kind of improve, I think, dramatically improve your results. And these are kind of practical ways to help you stop from overtrading. So the first one is trade only from a written checklist. Now we have a checklist that we give our students. And so what you do is you just, if your setup doesn't check every single box, then you don't trade. The second one is scheduling your trading. Now, we're not in the OWA, we're not glued to our screens all day. We're not day traders, right? Our strategies are designed around intentional decision making rather than constant monitoring. So, for example, I typically geez, I can't talk. I typically place credit spread trades at the end of each month. And each of these spreads that I sell, I will aim for an end of month expiration. So this sets up a repeatable system for me and a habit that at the end of the month, we're nearing the end of the month. So I know this is when I sell a credit spread. It also allows me to monitor the ones I have. I know that a credit spread in most cases is not going to expire at the beginning of the month because I aim to do the end of the month ones. It can't be that way all the time. I have to take what the broker has for me, but that's typically where I'm at. Number three, keep a trades you didn't take journal. Now, this is a new one. I didn't even think of this because I haven't done that, but it's a great idea. Most traders will only journal the trades they've taken or executed. So start tracking the opportunities you intentionally passed on, right? You'll often discover that many of those missed opportunities eventually validate your discipline rather than your fear of missing out. And number four, review your behavior, not just your P&L. This is something that we're doing more now in the Options Wealth Academy, and I just actually rolled something new out for my clients. Um, and I've talked about this in the past. You can have a trade that makes money that was done incorrectly. So winning money on a bad trade is still bad trading, right? Losing money on a well executed trade is still good trading. And that's one of the hardest lessons for investors and traders to accept. The process over the profits mindset. And you've heard me say it before. Our goal isn't to maximize today's profit. Our goal is to maximize decades of successful investing. That means focusing on the process, not the outcomes, right? Because as I told you before, and I've said this before, you can do everything wrong and have a winning trade. And that's dangerous, more dangerous than the trade where you did everything right and it was losing, right? So focus on the process. A repeatable process won't be one of luck, right? You'll be focusing on process, not outcomes, and one lucky trade can fool you. A repeatable process never will. So, some kind of final thoughts here. If today's episode makes you a little uncomfortable, it's probably a good thing because almost every investor has been guilty of overtrading at some point. I certainly have. The difference is recognizing it before it becomes a habit. The market isn't paying you for your effort. It isn't going to pay you for your screen time. It's not going to pay you for excitement. It pays disciplined investors who consistently execute high quality decisions. And at the Options Wealth Academy, that's exactly what we teach. We teach income and growth trading. We trade less, we risk less, and we think more because discipline, not activity, is what ultimately drives long-term wealth. So if you enjoyed today's episode, be sure to subscribe wherever you listen to podcasts or on our YouTube channel and leave us a review. It helps to reach more investors. It helps us to reach more investors who are looking to build wealth through discipline rather than speculation. So until next time, remember, protect your capital, trust your process, and never confuse activity with progress. And discipline drives results. So you guys take care. We'll see you next week. Bye-bye.